Good afternoon. This is Ken Long at Tortoise Capital with a review of the weekend trading report for April 9th, 2017. The market has increased its volatility to bullish volatile. This is still favorable on the long side, but we're alert to the increasing possibility of large directional moves in either direction. On an annual basis, using weekly RSI 14, we're at the high end of neutral at 68 out of 100. The threshold is 70 to get into overbought. Shorter term, on a 10-day basis, using 10-day NDX, the market is in the middle of neutral at 62 out of 100. Looking at the market Mosaic, price with respect to the 200-day moving average is 6.80% or white bullish. Slope of the 50 decayed a little further to 0.34%. That is also yellow neutral. ADX 14 weakened further, so a neutral trend. Looking more like sideways choppy as we approach that. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the threshold between risk on and risk off. The current reading is 0.988, so we are in risk off conditions. When we compare that to the last 5,000 trading days, find the average and standard deviation, we're able to compute the risk Z, the Z-score of that index, which is minus 0.23. You see here a 90-day histogram of that indicator. We've been stuck in this choppy, uneasy market now for almost 60 days. This rising inflection here is generally, I consider that to be favorable, but with recent politics and the fact that there has not really been any follow-through as the market begins to stall, I'm taking this as I did last week, and that is being alert for the possibility of short, sharp, negative price moves in response to political considerations. And so I'm emphasizing more of the day trading elements of our portfolio than the swing trades. I'm still taking swing trades, but they've got to be of the best quality with the reward to risk ratios that are very favorable. We just completed the blended monthly rebalancing model this week, and you see the holdings for April. And then these are the leaders as of Friday's closing prices. The theoretical model is exposed at 90%. The model portfolio is at 100%. Now looking at some blended monthly rebalancing insights. There's everything except the small caps is on a buy signal based on price relative to its 4-month moving average, with Latin America and technology still in the lead. In the ETF 32, still a handful of things on cash signals, but predominantly buy signals. Again, technology, Latin America, emerging markets on the rise. In ETF Max, again, I like to look for extremes in the 1-week percent column. These are all things that have been exceptional relative strength leaders over the last 3 and 6 months, so they're still in play. And those that have had extreme moves on the 1-week return are ones that I believe are the most likely to have larger swing follow-throughs as the market adjusts to that information. So things that are highlighted in red or green are the ones that are the most attractive to me as swing trade candidates. So things like China materials, India infrastructure, Chile, being greens across the board are ones that I look for continued strength. The ones that are in red, these large adverse moves over 1 week are ones that are either the beginning of a change in direction, so it could be a time to look at them as counter trend trades, or they will be seen as buy and dip opportunities by the people that already hold them. So that leads me to things like Brazil small caps, another small cap Brazil, and aluminum. S&P 500, same thing. I'm looking at these in the green that had exceptional follow-throughs like Vertex, CSX, and FMC corporations, and then the ones that had sharp adverse moves for framing in either direction. Again, Netflix, Hasbro, and Marriott. In the world market model, these vertical blue lines are 10, 20, 30, 40, 50, 60 days worth of look back. See, the slope of the 10-period regression channel is up. The slope of the 30 has rolled over slightly into the negative. You can see the moving slope of the 30 on this sine wave. This is where it crossed this dotted zero line, tells us what that slope value is. This is where it crossed the zero line here recently and starting to stabilize here, but still slightly underwater, slightly negative over the last 30 days. You can see the size of these one-day moves, which are now more likely as compared to the size of the daily ranges back during here this grinding rise. This is what that risk Z warns us about, is the increasing potential for these one-day large directional moves. These are very good days to be intraday trading and playing in with the direction of the day. And you see there's some large ones up, some large ones down, and so each day is its own market, and we don't carry a bias for directionality inside the day trade when market is in these kinds of conditions, but we're ready to play strong moves in either direction that usually happen right from the moment of the open. You notice how that the open in most of these days was near one of the extremes of the day, so we get a large directional move is what the trend is recently. I should say, if this price right here in the middle of the river is flat, the 30 and the 10 regression lines are inside the river, so this is beginning to be sideways channel. It's not quite quiet yet because of the size of these symbols, but for all intents and purposes, sideways quiet channel. If this market fails to the downside, I'm looking at the red lines, these previously held support levels, as the price targets on the way down. On the way up, it's got to get out of the river and the floodplain, and then it's free and clear with all-time new high. And so the market really has to get above this 240 to really tempt us in that direction. So a bi-directional market with increasing volatility intraday is what I'm continuing to look for. In the ETF2, we're looking at all of the symbols except for IWM on a cash signal, and that's what puts us at 90% invested, 10% cash in that model. EFA at 62 is equal to the S&P at 62 on the strength column. Inside the U.S., it is large caps, then mid caps, then technology, and small caps in terms of relative strength. The two strongest sectors, EFA at 62, and U.S. large caps, S&P, also at 62. Two weakest sectors are the European 350 and Latin America. Inside the U.S. sector spiders, those 9 components of the S&P 500, still great strength in technology and extreme weakness in energy. Inside the world market model, see, it's a mixed bag inside the U.S. Those in white are above average. Those in yellow are below average. Red is exceptionally below average. Strength basically in Asia, in Malaysia and South Korea especially, but real weakness in China and India. So a mixed bag. Europe is looking pretty much strong all the way across the board, with the exception of Belgium. Canada, Brazil, Mexico, all looking good, along with emerging markets. And in the other asset classes, private equity, oil, and treasuries are lagging, but gold, silver, corporate bonds, and real estate thriving. The ETF2 database, the top 30, a different angle on these. Those that are green and green are exceptionally strong on strength and on consistency, which is a 10-week moving average of strength. The ones that are green and white are the ones that are showing the greatest acceleration recently. They used to be above average in the white for consistency, and now they're exceptionally above average. So that's areas that are growing in strength, and that may be of interest to us here in the UK, Lyrian MLPs, and Switzerland. Same philosophy, but now looking at the Dow 30. Strength in the strength leaders continues: AXP, Intel, Coke, Microsoft. At the bottom of the stack in the reds, the weak areas in the Dow: Disney, Verizon, Excel, and Goldman Sachs. Just how quickly things change. Back in February, Goldman Sachs was the strongest in this whole stack, being greens across the board. So we have a relatively sensitive measure of relative strength here. Shifting now to the daily report. We've seen these indicators already. Here are the symbols that are standing out in terms of mechanical swing signals. You can see the decline in ADX here, with bulls only slightly in charge, but weakness and decay across the board. The Dow 30 tactical summary: plenty of dojis on quiet price action on Friday. 4 channeling signals, 4 triple screens, and just a few on the auto framer that test out better than 2 to 1. Inside the ETF tactical, some triple screens and 551Ws are available. EFA and Japan really stand out in terms of the auto framer. Here are the auto framer and regression line fractal framework leaders, and these give you slightly more advanced techniques for picking out your swing traits. And the daily squeeze chart, these are the ones that have had strong moves over the last 30 days, large ranges, but had a quiet range day on the previous day. And so the combination of large average range and a temporary one-day pinch creates conditions for a day trade, end-of-day trade, featuring a breakout from yesterday's range in either direction is one that we would follow, and the idea being that if it gets a large range move, we could have an excellent swing trade one day at a time using this technique. And so you see them ranked here by reward to risk ratio, and these are all members of the Dow and the S&P. Shifting further into the daily, basically flat for the last 30 days. You can see that the slope of the 30 is pulled all the way back to the long-term average and slightly below. We're closing in on the S&P 500, getting back towards the historical norm of the last 180 days. And we notice the decay of the 30-period regression line has started to flatten near the long-term moving average. Now, interestingly, that's I don't see that necessarily as a sign of weakness. That's essentially what you get when the market is cooling off. And if we look at the price action, we haven't been failing. There's been this one test, maybe half a test here of the downside, but buying pressure came in. And so this really has been an engine that was overheated that has been running closer to idle for the last 30 days. And that actually creates conditions for a continued move up. If we don't get that big fail down, at some point this is ready to go higher. Some additional market mosaics, and I will leave those to you to review. What really stands out here is IYM small cap value and XLB materials stand out as being above average on the returns of the last 5, 10, 20, and 40-day returns. So there's some enduring strength in those two symbols. Looking at the z-scores of our three regression lines of interest, the 10, the 30, and the 90, you see the 90 is continuing to roll over, and it's just about come back to normal. This is a place where it wouldn't surprise us to find support, and if it does, then getting past 240 would certainly be a possibility. You see the 10 oscillates quite nicely, has found support at the Z-1 and has bumped up this week. And the 30 is near at the bottom of its normal oscillating curve. And if we were to see this kind of a uptick, then you would expect to see this kind of an upward move. So this uptick leading to this move. And both of these occurred after decays in the slope. All right, so that's everything I wanted to cover for this weekend. Plenty of things to choose from. Again, I'm preferring the shorter term follow-throughs and cashing them when I have money in hand rather than carrying a lot of additional risk overnight. I don't see the edge in doing that right now until the risk Z improves. Other than that, that's all I have for you. Take good care of yourself. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.